702.
702.
Stephen is on the Money Show.
6 to 8 p.m.
Well, Eskom confirming today it was able to make a profit of just under 24 billion rand before tax, partly because it was able to dramatically reduce the amount of the amount of money it spent on diesel. But the real story, I suppose, is that Eskom has pretty much ended load shedding, and at the same time, it says it's making big inroads in preventing corruption and crime at the utility. The Group Chief Executive Officer at Eskom is Dan Marokane. Dan, good evening and thank you for the time. What's changed in Eskom that has led to such a dramatic change? Hardly any load shedding, maybe no more in the future. You're using a lot less diesel. What's changed at Eskom?
Good evening, Stephen, and good evening to your listeners. Stephen, I want to accept the use of the word dramatic. If you look at the performance to date, vis-a-vis the performance at the peak of intense and frequent load shedding back in 2022-2023, but within the context of a very clearly thought-through plan for operational recovery as captured in our Generation Recovery Plan devised in 2023, April, May, we expected to see this kind of results as long as we stay the course in terms of disciplined execution. The operational performance that we are seeing is really coming on the back of having identified the pain points throughout the coal fleet in particular, resourced it appropriately with the support from National Treasury that allowed us to be able to do our planning and the purchasing of spares on time and the timely onboarding of contractors and our own resources, and then staying the course in terms of execution and doing the necessary course correction where necessary. You'll recall, Stephen, 2 summers ago, we embarked on a very massive maintenance program that saw us having load shedding in the summer, and we said this was going to be short-term pain for long-term gain. When we had some challenges at the beginning of this calendar year, we indicated that we saw slippages from returning units from maintenance being the cause of those load sheddings. We have gone through the massive maintenance program. We are seeing the results with the improvement of the energy availability factor. And when we perform at the level that we are doing, we expect the finances also to start telling the same story. And this is exactly what we see. Yes.
So you did that big maintenance. Some of the equipment that you're using and I suppose relying on is still quite old. Some of it's very new, of course, if I think of Medupi and Kusile. Are you ever going to be in that position again where because it's old, it needs another big maintenance program, or are you better able to manage that going forward?
So, Stephen, I'll tell you this. In engineering terms, there's nothing that is old. As long as you do the maintenance appropriately, follow a consistent philosophy, you'll get the performance out of the equipment. We do refurbishments, and I'll give you an example of one of our power stations. Hendrina Power Station is one of the oldest. Hendrina, for a very big part, since May, June, has been running at over 70% energy availability most of the time. It is old, but it is well maintained, is cared after, and there's timely interventions. What we need to do going forward to sustain this level of electricity security is to ensure that we do not ever go back to a point where, because of money scarcity, we are unable to execute the maintenance programs as and when they are due. This is fundamentally what brought the business to a state that was in, and that's part of our sustenance activities going forward here.
Okay, you've made a profit, Dan. You say that the money will be invested back into Eskom. Presumably that's not going to allow you to reduce tariffs anytime soon.
Look, our debt levels are still high, Stephen. You know that we started off at the peak of, 2 years ago, we are sitting at about 450 billion. The NT National Treasury intervention is underway. It's reduced now to 230 from the original 254 or 252 or so. We still have 18 months to go on that. We need to get down to a sustainable level of around 300 billion rand. In the interim, we have to continue investing in the asset care, investing in the business to make sure that we now hit a new way that is consistent from a performance perspective going forward. So yes, these profits are good, they are surplus, but there's a lot of work to do internally in terms of reinvestment in the business.
No, sure. I mean, if we look at the history of Eskom, I completely accept that. You confirmed today you dropped your case against NERSA that was to try and stop the licensing of 4 electricity trading companies. Just to confirm, you're never going to bring that case back. It's gone.
No, Stephen, I did not say that. And I want to confirm, maybe to put this for you again for the record. This was correcting Chris Yelland, who went on to this. The minister asked the Eskom board to consider 2 things. A, to drop the case or to stay the case. To stay the case to allow the process of rules determination to unfold. We reflected as a business, the board reflected, and we are in the process of formulating the rules. We are participating with all other stakeholders in that part of the value chain with NERSA. We are comfortable that we'll emerge on the other side, and the period was about a 3-month period to be able to do so. Our focus is to really get to a point where we have a rule-based reform landscape, because we do not believe in getting into a reforms terrain that is not regulated or that does not have clarity of rules at all. And so we are very committed to participating in the formulation of the rules. That's what we are doing.
Okay, the issue as I understand it was that you were concerned, or Eskom was concerned, let me put it like that Eskom would not be sustainable if electricity trading, if these 4 licenses were given under the current circumstances, so under the current rules, or I suppose lack of rules. Do you believe then that there is a set of rules that could be adopted that would allow these electricity traders to be sustainable themselves, make a profit, and would allow you as Eskom to be sustainable?
So the issue in a nutshell was that we believed without rules there was an inappropriate allocation of cost to players who are not regulated like us. There are some fundamental assumptions that underpin the tariff pricing approach that is on the table. Left uninterrogated, it was creating an unfair advantage to those that are coming in unregulated. As a matter of fact, Stephen, these issues are being ventilated in the discussions at NERSA, the regulator. What you will see is an outcome that addresses each and every aspect of the components of the pricing structure. And we'll be very comfortable that a NERSA determination in these aspects will go some way materially different from where we started off in terms of our concerns. That's what we're dealing with at the NERSA process, yeah.
Okay, Dan, thank you. I do appreciate the clarity. There is also the NERSA inquiry into electricity charges. And as I understand it, this is really about the way that the charges that the customers, the end customer pays, how that charge is calculated. At the same time, and I made this point in conversations we had about this last night, the way in which Eskom explains to the regulator, NERSA, through its tariff application every 3 years, pretty much explains where your costs come from. Do you expect any of that to change? What I'm really asking, Dan, is as a result of all of this, do you think electricity prices, is there any prospect of them coming down, or at least having the rate of increase coming down?
What we need is a tariff determination environment that talks to the reforms that we are all embracing. So the current tariff methodology is predicated on a particular setup that is now outdated. If we start showing unbundled tariff and we have a lot of transparency around user pay for services, you will see a new tariff structure. And by the way, we are not the first people to go through this. All other countries that have introduced reforms like this have had to review, their tariff structure approach, and we are engaging with it. We know the big components of it. We need to understand who needs to play what role. And what capacity do we need to be held in case the country has to depend on it, who pays for it, and how do you pay for it. So the clarity of rules is something that we as Eskom have emphasized, that you cannot have rapid reforms outside an environment of updated rules. So the pricing, the tariff, the distribution rules, independent players at this level, all of this require rejigging because the environment which we are moving into is different.
And in the meantime, people who can pay, so let's just say richer people and companies, are trying to get off the grid, not quite as quickly as they can, but certainly pretty quickly. Every CEO I speak to that's not in the government sector talks about it. That's a real risk to your sustainability over the longer term, isn't it?
It is a real risk towards our sales as things stand, but we also have to embrace new opportunities in the reforms that are taking place. Stephen, I'll tell you that we spend time with our top 20 customers, commercial customers, industrial customers who said we are very much happy to see how you are performing your recovery. We had wanted to dabble into the issue of own power generation. It is not our core competency. We think that we may have a mutually acceptable solutions collaborating with you so that we can also move into your aspects and portfolio of renewable energy for us. These are opportunities that I imagine on the back of the realization of the renewed performance of the business itself. And by the way, to drive economic growth, you require more energy than what we have at the moment. We don't see a cannibalization of the current size of the market as being an issue. What we need to do is to grow the supply of electricity so that we can grow the economy. So there is a role for everyone to come into the space. As the minister makes the example, nobody goes and sinks a shaft to power it with renewables only. So there is a requirement for different types and technologies for different requirements in the economy. We've seen examples where utilities like us entered into a reformed environment similar to what we are going through, and they've actually seen growth in their sales going forward as the growth in the electricity demand in those countries increased as well.
Dan Marokane, I really appreciate the time. Thank you very much indeed. The Group CEO, the Group Chief Executive at Eskom. It's 24 minutes after 6. Listening to that, the energy expert, Ruse Moleshe. Ruse, good evening. To listen to all of that, do you think that Eskom has a great future ahead of it? Is it going to be sustainable if you look at all of the changes that are happening all at the same time?
Well, thank you, Stephen. Good evening to you as well and the listeners. Yes, I think there is hope for Eskom, although there are drawbacks, and if they don't succeed in that, they could face challenges. So the way I see it, from improving the performance of the power plants, of course, that's a positive. And then the cost efficiencies that they seem to be introducing, reducing the use of diesel, reducing those kind of things, improving that performance of the plant also increases the revenue that they are having, although they still depend on tariffs, and there needs to be certainty on tariffs. Where I see the drawdown, the challenges are within the municipal debt reduction space. And if the plans that they have to have at least smart meters and try to arrest that situation, and also have performance agreements with some of these municipalities where they claw back some of the money, then there is hope in that regard. So, yes, optimization of the balance sheet, of course, is not sustainable getting the debt relief from government. But the fact that they are looking to improve their performance and ensure that in the long run, with a proper tariff that is clear, that there's a proper path to sustaining that balance sheet, then yes, definitely, I see a lot of positives.
Jose, we're not used to positives in electricity. Do we need to actually stop for a moment, look at where Eskom was, look at where it is now, and, I don't know, celebrate, congratulate the management?
Certainly. We definitely have to do that. As Eskom is indicating, I mean, the number of days of load shedding, at some point we're at stage 6 load shedding, pre-2022 or around 2022, and now we've seen 96% improvement with very little serious interruptions. So that must be commended. And it must be commended for the fact that it's still sustainable. You're still going to see additional capacity coming in that is reliable. So that must be commended. I mean, with the Kusile power plants, at some point where the Unit 4 of the Medupi burning literally, So those kind of inefficiencies and those things have been improved. Of course, there's room for improvement. As I say, on the distribution side of things, that's where we have leakage and we have that debt that needs to be significantly reduced. It's approaching 100 billion now. And that those interventions, we hope that they'll be as methodical as they have been on the generation side, and that will turn around the situation.
Ruse Moleshe, thanks so much. Energy expert on The Money Show, 28 after 6.
The Money Show.
The markets.
Anthony Modasani is the senior equity sales trader at ABSA CIB. Anthony, good evening. Very strong update from Netcare.
Yeah, good to be here, Stephen. Yeah, a very surprising update from them there. Guiding for adjusted HEPS growth of 16 to 19%. It seems like their mental health business is starting to pick up quite nicely and stabilize there. So they went from a decline in the first half, and second half looks like things are picking up quite nicely. But it seems like they also have a decent amount of operational efficiencies that they're starting to benefit from.
BHP being told by China they can't sell any of their product in China. What on earth is going on here?
So I think that took the market a bit by surprise. We know there has been a bit of back and forth between Australia and China with regards to imports and exports of commodities. So this has to do with iron ore exports by BHP into China. So China's government entity sort of wants to dictate the prices at which BHP can sell the iron ore to them. So, excuse me, sorry. Yeah, so, we did see a knee-jerk lower in the market early on, down 4.5%, but the company did recover because I think it was a temporary ban and they will reach a solution at some point.
A negotiation, hey? MTN ending the day up very suddenly, up 5%. I mean, look, yes, a strong day on the JSE, but it seemed to come out of nowhere.
Yeah, that was an interesting one, Stephen. But I think if you look at the chart over the month and the performance over the month, it's actually flat. So I think what you generally have is guys will sort of look into stocks that maybe have underperformed over the past couple of weeks or so and see where there's opportunities to sort of buy it into month and just, to get a bit of exposure for it. So we haven't seen anything from a news perspective. It was a decent auction. The stock traded about 1.5 times its average daily volume. So that's decent volumes, but nothing in it at the moment.
And the gold price, I mean, once again, we've got the possibility of a shutdown of the US federal government. I mean, does it hit 4,000 if that happens?
Yeah, I mean
surely not.
I don't really think you can say that at that point, right? I think it's just we're in an environment where there's a lot of, it's very supportive for the gold price, right? You've got the Federal Reserve Bank cutting rates. It looks like they're going to cut some more, and you've got this pending government shutdown. So there's just quite a lot of things that are supportive for gold. So 4,000, I don't think is off the cards.
The US government shutdown. Pete Hegseth, the defense secretary, is currently upbraiding US generals about their grooming. So we can see, I mean, you really can't make it up. Anthony Modasani, thank you. Senior equity sales trader at ABSA CIB with The Money Show, just gone 6:30.
The Money Show.
With Stephen Grootes. Live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
And DSTV channel 856.
18 minutes now to 7 the time. Well, I don't know how often you've wondered as you go past an informal store, maybe a spaza shop or something like that, if you've ever stopped to wonder where the people selling you these goods get their produce from. Well, confirmation now from Trade Intelligence, 1/3 of the goods in our fast-moving consumer goods market are actually passing through the hands of what's called the formal independent sector. So outlets that are not linked to JSE-listed supermarkets. Most of this, an awful lot of this, is going to informal traders. 11% of our households are shopping at these chains too. Andrea Slubber is Insights lead at Trade Intelligence. Andrea, good evening. We all know the household names, your ShopRites and your Spars. We're talking about independent retailers and not parts of these chains. How they're able to be so resilient?
The independent trade is so well established in South Africa. I mean, if you look in the context of African countries, independent trade, informal trade, as we sometimes refer to it, is substantial, and it certainly serves the traders where a lot of households buy their groceries from. So it's a thriving part of the FMCG industry.
They must have a few things, they must lack a few advantages that other chains have. I mean, they're not necessarily of the same size. They don't have the same supply chains. Maybe they don't have the same capital. And yet they seem to be doing incredibly well.
You'll be surprised. Many of the big wholesalers and independent retail businesses are highly sophisticated. I mean, like you said, it comprises about a third of FMCG business in South Africa. And many of them, some of them even have like SAP-run warehouses, etc. So our perceptions around the independent trade is sometimes a bit skewed. And even if it appears to be unsophisticated, it is a highly sophisticated part of the business or the FMCG industry.
How important is the informal sector to all of this? I mean, a lot of the stock being sold in that sector every day sort of passes through these outlets on its way there.
Oh, for sure. I mean, if you look at informal traders, the bulk of what they sell are purchased from formal independent wholesale. Sometimes they also purchase through the corporate retailers, and in rare cases, for instance, bread, for example, direct from suppliers. But the majority of spaza shops and informal traders get most of their stock through formal independent wholesale.
They obviously prefer that sector to other sectors for some reason.
Yes, they do, and it's very interesting. On a recent trade visit, it just revealed what we've heard before, but relationships play a key role in terms of where traders buy their goods. And if you break down, I mean, why are these relationships so established and so important to the informal traders? It's because of the understanding of the independent wholesalers to the realities of an informal trader. So many of the wholesalers provide free delivery, depending obviously on order sizes, to traders. And that certainly helps a great deal, not only cutting on transport costs, but a trader certainly does not want to be away from their store, given that informal spaza stores, for example, are open for long hours in the day. So that's a big advantage. Sometimes the independent wholesale provides the best price, sometimes not. But even if they don't provide the cheapest price, the traders are still loyal to them. Some of them offer credit to traders, so that's certainly a big advantage. And then also the formal independent wholesalers often customize orders for traders. Think of a little tuck shop, for example, that sells chips and wants to stock small amounts of varied flavors. So the formal independent wholesalers some of them have sections in their outlets where these customized orders are picked and packed.
I was going to ask you about credit because I know that is for some of the spaza shops, it's what really makes them unique in their own communities. It's what kind of keeps them alive, and the communities come to rely on that. Clearly, that
Absolutely.
it's moving up the chain in an important way.
It is, definitely. I mean, buying on the book is part of the independent trade, from household shoppers to the spaza stores to the wholesalers. So that is really the dynamic, which is very well entrenched and established, and there's a big sense of trust between those different stakeholders, and it seems to be working really well.
So, I mean, exactly, if the credit goes and you get the money back, that develops trust in a way in which I presume other companies or other organizations would really battle to compete with.
I suppose so, but I mean, you asked earlier, I mean, what are the sort of challenges independent trade, specifically wholesale and big independent cash and carries? They have those advantages in terms of getting loyalty from traders that buy from them. But a disadvantage, for example, is when we had severe load shedding, the independent trade really suffered. I mean, it shows in the numbers. Last year, corporate, retail or modern trade grew ahead of independent wholesale and independent retail, because corporate retailers can lean on their the corporate groups' alternative energy resources, where independent traders and wholesalers and cash and carry don't always have that or have to invest significantly in that. So loss of trading days or huge expenses to keep the business running was a big consideration in slower growth during 2023 and 2024, the beginning of 2024, due to load shedding. But just one example of some of the challenges that are unique to them.
What's the outlook for the sector? Are you expecting it to continue to grow from what you say, sort of it's kind of entered a period of growth after a couple of difficult years?
Yes. What we are seeing at the moment is momentum is picking up. And we do believe, for many years, it's interesting, the growth in the independent trade outpaced modern trade or corporate retail. It gets complicated because over the past year, we've seen store openings, new store acquisitions, store conversions, a lot of that's happening within the modern trade space, which has given the corporate retailers an advantage in terms of growth rate. But we see a lot of innovation happening in the independent wholesale trade from the cash and carry formats. Many of them now invite a household grocery shopper into their stores, expanding their reach, opening convenience formats, some of them serving household shoppers, some of them serving as little midi or midway wholesalers to spaza stores. So I definitely believe it's a period in which the FMCG trade, specifically from an independent perspective, is growing strong.
Andrea Slubber, thanks very much indeed. Insights lead at Trade Intelligence. Really do appreciate it. Interesting just to see which sectors of the economy are doing well and how they're doing it in a way completely different to other parts of the economy. Big part of this, as always in business, about relationships and trust.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking, proud sponsor of South African Auto Week 2025.
8 minutes to 7 the time. Well, still no certainty around what exactly is going to happen with the go. And of course, quite a difficult political situation in the US this week. But also now important conversations around where our agriculture sector should focus, particularly because of what's happening around global trade. There was a big event on the sidelines of the G20 Agricultural Ministerial meeting recently. It was hosted by RMB and FNB, and that's ahead of the big G20 in November. Davi Marie is the head of Agriculture, Information and Marketing at FNB. Davi, good evening. So much is changing in global trade at the moment, so much uncertainty. How should our farmers and our agricultural sector generally be approaching this quite complex situation?
Good evening, Stephen. Thank you for having me. Yeah, as you mentioned, it's quite a challenging time with a lot of changes. AGOA that's expiring tonight at midnight some stage, which is if it's not renewed, a big loss for our South African agricultural trade. But apart from that, there's a lot of other issues that's also at play. The China that's offering our trading at zero tariffs, but obviously we are trading within the SACU block, and Swaziland is excluded from that. So a lot of uncertainty, as you've mentioned. Now, farmers need to, obviously, our exporting industries needs to do business in that environment. And I think that's a challenge that we have for our agricultural industry, is to make sense of this uncertainty and to make sure that our exports is going to the right destinations at the right price and at the right time.
That's difficult to do. Yes, there might be more potential markets in China, but are there other places we can look at?
Yes, China is not a be-all and end-all. India is obviously one of the big growing markets, growing population. Unfortunately, still a lot of high tariffs. And there is talks of a preferential trade agreement with India, but that is lagging for some years now. But other Far East countries, Vietnam and Singapore and Malaysia are also top of mind and growing and developing countries that we can use. And then there's always the Middle Eastern countries, the oil states that's growing quite quickly and accepting agricultural exports from South Africa.
So, I've made this point so many times. If global trade is recalibrating, we should be knocking on doors that are already open. People will want to buy our stuff. We will want to buy theirs. Is that actually happening? Are you seeing that process actually happening in real terms?
Stephen, unfortunately, very slow. It's some of these trade negotiations takes more than 12 years, for example. For example, the agro industry, it took them 12 years just to open the Chinese market. So slowly but surely it's changing, but it's not changing fast enough. And I think that's where government must come to the party and start kicking open those doors. Because these trade agreements and trade negotiations can't be done by individual businesses or by industries. It needs to be government to government. And as soon as government kicks open the door, the industry can come in and they can supply the market, they can develop and they can grow that export market. Because the moment, people in other countries taste our produce, they want that, as you've said. We've seen that with citrus. We've seen that with meat exports to the Middle East. We've seen that with various other exporting products. There is a high demand for South African products.
Our president and quite a few others have made the point about intra-African trade. And I mean, for as long as I can remember, people have made the point that if we traded with Africa and if Africa traded with itself as much as it should, then everybody would be a lot richer than we are now. I think around 40 or over 40% of our agricultural exports go to Africa. Is there much more space for our exports? Could they absorb more of our product?
Yes, definitely. Africa is a growing market, and if you look at it, the top growing economies in the world, I think out of the 10, 4 or 6 is in Africa. So definitely a big potential. Also, high population growth, high economic growth, and that assists obviously with demand. But there's still a lot of uncertainty around trading into Africa. It's not easy to do business, and obviously one of the big stumbling blocks is the logistics, the infrastructure going into Africa that is underdeveloped. That is changing as well, but not changing fast enough to make sure that we can export on a continued or a sustainable basis, quick enough.
We know that trade makes people richer. I mean, this has been shown again and again throughout human history. We might unfortunately get an example of what happens when some of that trade stops in the near future. Let's hope it doesn't pan out like that. Do you get a sense that things are recalibrating? I wonder if some people are just waiting to see if the United States comes to its senses.
No, definitely. I think there's definitely a recalibration in trade. Obviously, President Trump has thrown the cat into the pigeon cage, and that changed a lot. Obviously, with the recalibration, there's a lot of opportunities coming into the mix as well. People or businesses that relied a lot on the US as a single market now realize they must diversify. And that just makes business sense to diversify your market into other areas as well. Traditionally, the EU was our biggest trading partner, and we've seen changes in that as well, with the EU economy being stagnant and not growing fast enough, and hence our farmers and our agri exports looking into other markets. So definitely a change, but not fast enough.
Davi Marie, thanks very much indeed, the head of Agriculture, Information and Marketing at FNB. Very interesting just to see how that all pans out. And I sometimes wonder, and I realize this is unfair because not everything can or should be done in public, but I do sometimes wonder what is going on with the Department of Trade, Industry and Competition. How much work is being done? I would like to think a lot of work, and there's been some evidence of that in the last couple of days. Sometimes, though, in situations like this, you do have to be seen to be doing something. I do wonder if there is enough of that. Otherwise, people are just going to ask questions. What are you doing? How is this going to change? And if things then go wrong, people are going to blame you. We'll talk a bit more about the energy transition in the next few moments. We'll hear from Rotendo Ndwingwi about what's happening on our continent. And don't forget Warren Ingram tonight. Bit of a tough one. He's talking about how you plan your finances after a divorce. All of that to come with The Money Show at 7 o'clock.
The Money Show
with Stephen Grootes.
The Green Economy on The Money Show is brought to you by the Rose Foundation, giving used oil a renewed purpose and supporting a clean environment one drop at a time. Well, you heard earlier from the Eskom CEO, Dan Marokane, about how the utilities improved its performance. It's about to end load shedding. It's dramatically cut back on the amount it's been spending on diesel. But most of their generation capacity does still come from coal and will for the foreseeable future. Jan Fourie is the CEO of Moleshe. Jan, good evening. Load shedding's pretty much over. Have you noticed a lack of urgency, maybe a slowing down in the kind of move towards renewable power? Have we taken our foot off the pedal a little bit?
Hi, Stephen. Thanks for that. So I think it's great for all of South Africa and the economy at large that load shedding has been reduced. I think, however, there's some of the things that's busy happening that we need to push harder on in terms of, we've spoken about this before, grid and finishing market liberalization and some other matters I think that there needs to be addressed there, where I think some of the load shedding pressure has been taken away from that. But I say hats off to Eskom for the work that's been done. But there's been a multitude of factors I think contributing to kind of the reduction of load shedding.
Do you believe that? So what really drove people to get their own sources of power, to put solar on their roofs and things like that, was load shedding. Without that, do we then find that people don't push so much? The result of that is that we might be using coal-fired power for longer.
Yeah, so what you'll find is on the residential side, that was very much a drive. In the kind of private power and commercial industrial side, their off-takers are looking at other factors beyond load shedding. Also just kind of given the additional, call it, increases to the power prices, people are also looking to be able to manage those OPEX lines that's got a big contributor to their budgets, and see how they can, one, make it affordable, and two, just make it more predictable than through the kind of the pricing that we're currently getting from Eskom. So the drivers are different between, I want to say, residential and larger commercial industrial off-takers.
Many companies are using solar power where they can, and that works for them generally speaking. But what would really change the game is battery storage. Is that technology changing? I suppose what I'm really asking is that price changing?
Yeah, so Stephen, I think that's where, we in the industry and at Moleshe, we're particularly excited seeing what's happening in the battery space, and it's not just happening in South Africa, but globally. I think the amount of investment that's gone into batteries and the battery supply chain has just driven down costs at a rate that no one was expecting. And so the combination of cheap renewable power with making it dispatchable through storage is really a game changer for the South African grid. We need this kind of more flexible generation, and then for off-takers, so that we don't only have power when the wind blows or the sun shines, but when we need it.
I presume we're getting to the point where a much smaller company could afford that than could, say, 5 or 10 years ago. We're looking at really medium-sized companies now. In the past, it was really big companies.
That's correct. No, so given how much the unit costs of power is, or the best prices, battery energy storage components have come down very much so. So the combined prices thereof. So, however, at the utility scale, that's where you really see kind of the sharp pricing happening. And at Moleshe, there's a number of projects that we've won in government auctions, and the volumes that we need to procure, we are seeing some very sharp prices, and that we can then, of course, pass on to both government and to the private sector.
One of the big problems for the private sector, okay, you get your battery storage, but you also need space for solar power and things like that, and in densely populated areas, that may not be that easy.
Yeah, that's correct. So I think for businesses also, you can fill up your roof to a point, but then I think what's really nice is using a combination of both, say, behind the meter storage and wheeling, being able to procure power cheaply from large facilities that's located in areas where you do have space. Where it used to be the Northern Cape, that's now gridlocked, as you know, but kind of places like the Free State or Northwest or Limpopo, where you can build these facilities at scale, wheel it to these industrial facilities where they get the benefit of cheap electricity, as well then as the benefit of these battery energy storage or large batteries, either on-site or off-site, depending on whether you're wanting to also secure load shedding or just being able to provide power into some of the peaks when the sun is not shining.
There's a big debate, Jan, I'm sure you're aware of it, around whether we should use gas. So it generates lower emissions. It is still a fossil fuel. Sometimes people call it a sort of transition fuel or a transition system. It is dispatchable. You can switch it on and off when you need it. Do you think we need gas, or are other transitions happening almost too quickly to create a whole gas industry?
Yeah, that's a very good question, Stephen. I think when it comes to gas, obviously we need gas and a good gas supply for other industrial uses. When it comes to power and power generation, I think given how quickly the transition is happening with batteries, wind and storage, and the fact that we don't have a meaningful gas reticulation infrastructure, nor do we have, call it, domestic supply of gas. So we'll be reliant on importing gas that's a globally traded commodity and denominated in foreign currency. So the ultimate price of the electricity would be a function of kind of the price that we land the gas at. So if it's high, the prices of electricity would be high. So kind of the unknown in being able to kind of really predict and kind of crystallize that price, makes it quite volatile. And then you're sitting with the infrastructure that you still need to create. So can it work? Yes, I believe it can work. But given how quickly things are developing, you don't want to go, call it, down the line and then end up sitting with stranded assets. At some strategic points, it could work. But, I think the verdict is out on that one.
It's interesting because there are some people who are very, very keen on the idea, and yet it seems to have just disappeared. Partly, I suppose, as the kind of cost of creating such a big industry start to become really apparent, and the fact the Mozambique gas fields are pretty much done also plays into that.
No, exactly. And then, what people are also not factoring in is that to get your hands on a gas turbine at the moment, you've got a very long lead time. Because of the big data center boom kind of across the world, and particularly in the USA, getting your hands on gas turbines, the lead time of those things have also extended into years. These global factors are also would be contributing to how long it will actually take to build facilities locally. From the time that you say, well, we've got gas available, funding that facility, and then starting with construction. So I guess when we can get these electrons on the grid is a function of all of these global factors.
I hadn't thought of that. Thank you very much indeed, Jan Fourie. Really do appreciate it. The CEO of Mililo. Interesting to see how what's happening in one part of the world in terms of AI and electricity generation is having a big impact on us as well. Every drop of used oil matters. That's why the Rose Foundation is committed to the responsible collection and recycling of used oil, keeping harmful waste out of our ecosystems and away from our communities. By supporting their efforts, you're helping protect South Africa's natural resources for future generations. Be part of the solution and help build a cleaner, greener South Africa. Visit rosefoundation.org.za. Greener tomorrow with yesterday's oil.
The Money Show.
The Africa Business Report.
Dr. Rutendo Ndingwi is the founding director at Tribe Africa Advisory, author of the book Rumble in the Jungle Reloaded. How's it, Rutendo? Looking at the situation in Cote d'Ivoire, Ivory Coast, their Berlin project, ENI has sold a 30% stake in it.
Hi, Stephen. Good evening to you and your listeners. Yeah, as you know, Cote d'Ivoire is obviously quite focused with regards to cocoa exports, and obviously the headquarters of the African Development Bank. ENI, a big player with regards to the oil and gas and a number of mineral-related projects in Cote d'Ivoire. So this is just highlights again in terms of the opportunity of countries like Cote d'Ivoire that are also looking at just diversifying their market, and they're seeing other opportunities that they can actually capitalize on with regards to allowing multinational players to come into the market and diversify from from there. So it'll be good to see how this project translates to economic performance and takes the economy in the right direction, Stephen.
Yeah, obviously it depends on what happens with the oil as well. Maputo, in our neighbor Mozambique, they're expanding and they're sort of seeing themselves as a kind of regional logistics hub.
That's true. Maputo, Stephen, is 90% of the volumes that go through its ports are actually coming from South Africa. So it's got quite a strong relationship with South Africa. The challenge is, South Africa from a Transnet perspective, a logistics perspective, has been taking a bit of a knock. Maputo has obviously attracted investment through DP World. DP World is trying to leverage off its capability from the Dubai Jebel Ali Free Zone, where it's got about 11,000 companies that it services in that port. So it's bringing the IP and that knowledge to Maputo. Just to give you some stats, Stephen, the Maputo, with the investment that it's getting from DP World, DP World is wanting to invest about $1.1 billion US by 2033, and they've got a 2058 plan. So you can see they're really playing the long game in this. At the moment, they're wanting the next 2 years, Stephen, they want to move from about 255,000 containers to 530,000 containers. And that just talks to the volumes. Compared to South Africa, that's too low. Durban is the biggest port for South Africa, and that pushes about 3.6 million units per annum. So it's quite a significant number with regards to where Mozambique is wanting to play. But I think the key thing just to highlight here, Stephen, is that there's great opportunity for Mozambique. It's obviously gone through a bit of a political challenge with regards to the recent elections. But ultimately, when you look at the dynamics, what's happening globally, the port itself is a big haven for the Dubai Middle East players to come and invest and grow. And the forecast that I've just shared, obviously, are looking at 2058. But it's a great opportunity for Mozambique to capitalize on and ride going into the long term.
Well, you mentioned the politics. I was going to say, by 2058, the government there will probably have changed, possibly several times. And we know how difficult the last election was for them.
No, it was. And, I think the same thing about Maputo is obviously, remember, there's also the other challenge. I think it's more up north with regards to the to the insurgents and what's happening there. And obviously we've got the history of Frelimo and obviously we've talked about the politics happening at the moment. But I think that's the challenge or the opportunity with Africa, as much as there's a lot of uncertainty. And I think Adrian Go highlighted this, amongst that crisis, there's still opportunity. Well, what I would love to see more is that opportunity translating to economic benefit that then translates to social positive impact and people benefit. But peace is the best thing. But even in all this VUCA kind of world that people talk about, which is where Maputo is, investors are coming in and saying, guys, we want to play the long game with you, and we're seeing the opportunity. I think the warning sign, although Maputo says or Mozambique says that they're not competing with South Africa, it does create an option for ports when people are looking at it from an Africa perspective. Durban is still the biggest port, but Maputo is slowly investing and going to play a competitive role going into the future.
Yeah, no, very interesting. And I mean, surely, despite what we're seeing with trade at the moment, the movement of goods around the world just continues. We know that the price of coca, which is the main ingredient in chocolate, has been sky high this year. Now the UN is trying to help protect some of those plantations in Sao Tome and Principe.
Yeah, Sao Tome and Principe, Stephen, a very small set of islands up in West Africa. GDP is like 764 million, a population of 235,000. So very small, but GDP per capita is like $3,000, and the year-on-year GDP is 1%. So just to give context, it's a very small country in terms of that respect, but it lies a lot in terms of cocoa exports. And just to give you a figure, on an annual basis, they are looking at about $10 million that they export out of the country. And there's a cooperative that has been put in place, and the UN is trying to safeguard this, that is actually allowing people to be employed. So there are about 37 producers that are part of this cooperation or NGO that puts together work with regards to producing cocoa and helping the society. And it impacts about 2,000 families. So this disruption that is coming to their exports and to their industry is obviously UN is trying to intervene and say, look, there's a social impact. And I think this is good, Stephen, because some of these smaller countries that don't have the clout and they don't have the strength of the bigger countries can easily be taken advantage of. So UN intervention is quite strategic, but also very necessary in this day and age where the small voice can easily be lost in the bigger noise in terms of what's happening out there.
And the Western Sahara, which obviously our government sees as under occupation by Morocco, but the Trump administration has recognized Morocco's sovereignty. Now Trump is helping American companies invest there.
Yeah, so again, another wildcat that's been brought out of the U.S. foreign policy. Just to give the listeners the background in terms of why Western Sahara is where it is at the moment. There's always been a big conflict between Morocco and Algeria in terms of saying who owns what part of Western Sahara. So that conflict has gone on for a number of years. Western Sahara as a country is recognized as a 55th state by the African Union, but the rest of the world, because of the ongoing conflict and the political history behind it, doesn't recognize it. So especially the United Nations. So there's a bit of a disnormal there. But specifically with regards to this, one of the big exports that comes out of Western Sahara is phosphate. So there are minerals and there is export commodity that America is attracted to. So President Trump, through the DFC and the USA Export-Import Bank, have put initiatives in place to protect American investors and companies, and as well as to cushion the risk of them doing business in that environment. And for them, obviously, we know President Trump is a transactional person. It also creates a bit of a opportunity for him to get one up on China, because China was wanting to invest plus or minus $20 billion in that Western Sahara, and that's still work in progress. And France itself has also invested significantly in Western Sahara. So there seems to be a lot of opportunity there and a lot of attraction to multinationals, and President Trump or the US is not holding back. From a political perspective, it does create a bit of a mayhem. As I said, Morocco, Algeria. I know there's been an Israel debacle as well related through Morocco in that. So it'll be quite interesting to see how it all unpacks, Stephen. But at the end of the day, it's a strategic move by the US, and let's see how it turns out.
Thank you very much indeed, Dr. Rutendo Ndungwe, the founding director at Tribe Africa Advisory and author of the book Rumble in the Jungle Reloaded. A lot going on our continent.
The Money Show.
Personal finance with Warren Ingram.
Well, a difficult subject tonight, how to plan your finances after a divorce. And Warren, I mean, there's a terrible joke that goes back many, many years. Why is divorce so expensive? And the answer, I'm sure you know this, is because it's worth it. And it's the kind of thing that's muttered under the breath of people. Is terrible. It is horrific. When I first heard it, though, I must confess, I did burst out laughing because I thought it was funny. Thankfully, I've never been for it. But the fact is, and there's no way to get around this, a divorce is very stressful, very difficult. Some people I know say it's the worst thing they've ever been through. But it also is also very expensive.
100% right. I mean, I don't have an exact number for it, but to me, it feels as if the couple can get to the other side of this as two individuals with each of them having a quarter of what they had before. So you don't just halve your wealth; your wealth goes down by another half. And the reality is that you're taking two households, from one, and unfortunately, some of those costs aren't just half. You don't just pay half the government's, rates and taxes. It's always going to be more. And if if there are kids involved, you're almost providing two sets of everything for the children if they're the custody is shared. So it is a phenomenally expensive exercise. And it's interesting. I mean, probably not surprising though. But there's a wonderful book called The Millionaire Next Door from the US, and they studied millionaires, over a long period of time in America. And one of the things most of them had in common was they weren't divorced. They had been married once and stayed married. And that's not, comment on people who are getting divorced, but it's just a reality that's how expensive it is, that your chances of financial freedom are a lot diminished after a divorce. So yes, Stephen, one very expensive, very stressful and very traumatic exercise for the people involved.
Sure. I suppose the first thing is that you need to really understand what is going to happen. You need to, be realistic about what your position is going to be. You're used to one thing, where you're going to be next is going to be very different.
Yeah, I think it's a psychological journey you have to go on as well as a financial journey, because you know, in anything like this, there's going to be a period of time where it feels unreal. And you might continue living as if you are, you know, on the same income stream, a double income, for example, and you know, the same single expenses, and that could get you into financial difficulty very quickly. So unfortunately, you have to hit a reset button, you know, when you get to the other side of a divorce, and starting with just understanding how much money is actually coming into your finances now. So, for example, if you're the beneficiary of a spousal maintenance or child maintenance, understand what that is. Understand, you know, if you're now on your own income, what does that look like? You know, do you have any income from investments? But it's critical to sit down and actually get a proper idea of what's coming into the bank account on a monthly basis, and is it sustainable? And from that, you then can decide how you're going to spend your money. And I think it's an important point. You start with what's coming in, and that determines how much you can spend. And a lot of the time when I have conversations with people coming out of a divorce, they say things like, it's impossible to get by with X amount of expenses on a monthly basis. I need to spend more than that. And unfortunately, that's not the reality. The reality is what's coming into your bank account is your reality, and that's the amount of money you can spend on a monthly basis. So you have to make that adjustment very quickly, and it might seem very harsh, but that's your cloth as it's cut now, and making that decision, both psychological as a journey and then you know, physically in a budget will help you to kind of get back on track and to get going. But I find a lot of the time this is a process that takes months and months and months, and you just watch the financial hole getting bigger and deeper for people until they accept their reality. So if that's one message that people are listening to tonight, it's to say you have to accept this. You have to look at your income as it is, and then cut your cloth accordingly, and to start to spend within those means. And it is expensive, no question.
One of the things about human beings, and particularly with money, is that we follow patterns, right? That's why so many people drink a cappuccino when they arrive at the office. They're following a pattern. In the case of this, all of our spending patterns get set after a while. Now you have to start again because you're no longer married, and never mind emotionally, you're no longer married financially. That's quite tough. Everything changes.
It does, and just to talk through some of the things that will happen is, you might have been the person carrying medical aid for the family, or potentially that was being carried for you, and now you need to take care of that. You might have additional childcare costs. Whereas there were two of you bearing responsibility for the fetching and the carrying, now that might be divided, and so you might need to get someone to help you with that, and so it just very quickly you realize that how life is not the same now, and I just think a lot of the time here it's a case of saying let's just get a realistic picture of how life works today. What do I need to do to get by? And with no frills, no airs and graces, no luxuries, etc. What does basic life look like? And as quickly as you can get to that point, and make sure that your income matches that, or your expenses match your income, then you can start to kind of replan and reset. But I think it's just understanding on day one where you are, and yes, the budget that you had when you were married, even if you were diligent and successful in the way that you were managing money, that's you can tear it up. It's a fiction now, and you have a new reality that you have to adjust to.
Okay, what's the first thing you need to do? First 2 months or so, your first financial priorities. Where do you begin?
I think it's just, firstly, maybe just look at what you have. In other words, what are the assets that you have today? If you've divided the debts, what are those, and jot them down. Just get an understanding of what's on the credit and the debit side of your personal balance sheet. In other words, what are your assets and what are your debts, and from there, just get an idea of any income that comes from the assets, and then if you have liquid assets, for example, if you divided some cash or money markets, etc., how can you use that to settle the debts as much as possible? And then from there, I would start with looking at all of the investments that you have and your insurance policies, your retirement funds, and understand who are the beneficiaries of those, because you were a couple before, now you're a single, so make sure that your now ex is not still the beneficiary on all of your life assurance policies, your retirement annuities or pension funds, etc. And a lot of people forget this, and so they just carry on, and then unfortunately they die, and their ex-spouse becomes the beneficiary of a life policy or an investment to which they actually weren't really entitled anymore. But that's what's written on in the agreement, so that's what's legal. So for me, step one, check those, make sure that you've got the right beneficiaries there, and then step two, and this won't surprise you, Stephen, but I'm gonna say you've got to fix your emergency fund. Make sure that you've got an emergency fund that's at least worth 3 months worth of your now fixed expenses, and ideally try and push that up to 6 months if you can. For a lot of people, they might be very cash poor after a divorce. The only people that are making money out of this are the lawyers, and so what you're trying to do here is then start building. And even if you add 500 or 1,000 rand a month to your emergency fund, start small, but keep going and make sure that it gets to the size it needs to be as fast as you can.
We're talking to Warren Ingram tonight, personal finance, how to financially manage a divorce. Your questions for Warren, 072 702 1702. Also called on 011 8830 702 and 021 446 0567. There are also issues about insurance and things like medical aid. How important are those to sort out? And something can easily fall through the cracks there, Warren.
Yeah, I mean, I would hope that if you were on a joint medical aid, that as part of the divorce process, you've now got your own. But if you haven't, make sure you get your own medical aid as fast as possible, and make sure that if there are children involved, that they're on the medical aid, one of your medical aids as well, because that's something you just don't want to let slip. And then make sure that you've now got insurance on your car, your home, especially the goods inside and all of those things, your physical stuff, because that's something you might just not think about when you're now living on your own. And then, it is important to check that you've got disability insurance. If you're working at a large company, it might be part of your employment, and in which case you've got some life assurance and disability. But if you're not, if you're working at a small company or you work for yourself, and you haven't worried about this, then this will be something that you will need to take care of as well, because the last thing you want to happen now is you have an accident and you're not able to generate an income anymore, and you're divorced. So the insurances, I know I sound like an insurance salesman at this point, but I think it's key that these are things you have to make sure you've got right. And then maybe just to talk about, we're entitled in law to get one credit report per year for free. And it's a very good idea to do that now, and make sure that you know what accounts you have, that they're in good standing. If there is anything where you've got joint debts that you didn't know about, or anything that's been mistaken, where there are errors in your credit reports, fix them and get them sorted. You don't want to go into your single life with potentially debts hanging over you that you didn't know about, and certainly those need to be clarified and cleaned up.
And then often, I mean, you're in a position now where you're creating a new home. You have to buy things, buy big things sometimes. So you need to be a bit careful about that.
Yep, I think a lot of the time, especially if you were living in a home that you both owned, one of you might get the home in the divorce. That's then that's fine. You're staying where you are. But if not, and potentially that family home is sold, the temptation is to take the proceeds from your share of the house and to buy a new house. And the conversation usually goes something like, I've got kids, I need to give them stability, and they need to know where they live. This is their new home. It's been traumatic for the children as well. And all of that's true. I'm not disputing it. But we're emotional beings, and making a very large decision like buying a house straight after a divorce is probably the worst thing you can do, because you might find that you end up buying the house that's not appropriate for you, or it might not be in the right area, or potentially your finances actually aren't suitable for the house that you've just bought. So my suggestion in a situation like this is rent a place and make sure that you give yourself a year or two to figure out what your new life really is all about. And then you can reconsider the decision to buy a house or not. But I think, knowing that, decisions like this, we only normalize and stabilize after very big traumatic events after about 2 years. And retirement would be one, divorce is one, retrenchment is another. And so, give yourself the time and space to kind of go through the whole emotional process and realize you're just not going to be as rational as you could be until you've gone through that whole process. And therefore, don't make these big decisions now.
Such interesting advice. All right, your questions for Warren Ingram, 072-702-1702. Barry sent through a question today saying, I've invested a lot of extra money in my bond over the last 5 years. My interest rate is prime less 1%. I was thinking of using some of the extra money from my bond to invest in the stock market. Markets are doing so well at the moment that I think I can grow my money more quickly in the markets and then settle my bonds sooner. Do you have any suggestions for where I should invest? It's a very interesting question, Barry. We'll have an answer from Warren in just a moment. 10 minutes to 8.
The Money Show.
Personal Finance with Warren Ingram.
Warren, of course, is the co-founder of Galileo Capital. We're talking about the personal finance aspects of getting divorced. But first, Warren, Barry's question, he's got money in his bond. He wants to use some of that extra money to invest in the stock market. Where should he put it? Quite a controversial question in its own way.
Yeah, it's a tricky one. So when we make investment decisions, one of the things we're doing is we're dealing with probabilities. In other words, we're dealing with the potential that the investment that you're going to make is going to deliver a good return. And when you've got a certainty, like in this instance, prime less 1 is the certainty. What you know is if you take that extra money, some or all of that extra money out of your bond, you are certain to pay, I think it's 9.5% to the bank for the money that you've taken out of the bond. So that's a guarantee that and what you're doing then is you're saying, I'm going to take that money and I believe that I can put it in an investment which is going to give me a better return than that. And you need to get paid a fair amount of extra return for the risk that you're taking. Because if you're going to invest in the stock market, it could give you 25% in a year, and it's certainly done that in the past. But equally, it could give you a minus 33% in a year. And it's done that quite a bit in the past. So you need to say to yourself that the probability, the potential growth that I can get out of an investment like this must be significantly higher. And when we look at the stock market, and it is my favorite asset class of all time, it will give you a growth rate of about 12% a year over a typical 5 to 10 year period, which is very nice. But it's not that much more than the 9.5% that you're forced to pay on your bond. And when stock markets have done well, and I'm not arguing that point, I think they have done well, but when they've done well, the likelihood is that they don't carry on doing well for the next 5 years. Somewhere along the line, they hit a speed bump and they go down. So I'm going to say, Barry, I think you've done well to put the extra money in your bond. And if it was me, I would keep putting extra money in the bond. And when I don't have a bond, I'll start investing extra money into the stock market. But if you really are going to do this and you're going to disregard that suggestion, then I think maybe pay a little bit less into the bond because you've got that flexibility now that you've put the extra money in, and phase some money into the stock market, and then diversify. Put some in the world index and some in the JSE top 40 or top 50. But I wouldn't be too specific in an individual share or something which might just halve on you. You never know.
Yeah, so it's, as always, it's about, just making sure that you spread the risk. Okay, longer term financial planning when you get a divorce. You need to start, I suppose, by knowing what you have, because everything will have changed so radically.
Yeah, I think one of the things is we with divorces you now figure out what assets you have. You've hopefully got to the point of understanding what your costs are, and what that allows you to do is to say, if these are my assets and these are my costs, you're now in a position to start doing some financial planning for your future, and that will help you to understand where you're going. And in the early days, that number that you need to be able to reach your financial freedom goals is probably going to be a little scary. And that's okay. In a situation like this, you need to know what your position is. Don't ignore it and don't stress about it. Once you know your position, you can start to plan accordingly. So I think take the time to do a recalculation of your position and then make a plan. The other one for me that's very important here, especially, it doesn't matter whether you do or don't have children. I think it's even more important if you have kids, but you have to revise your will. You have to make sure that you now have the appropriate people looking after your children if you die, and secondly that your assets are kind of given to the right beneficiaries. It's one of the few times I would say, when you're in a position like this and you are, emotionally going to be some form of compromised here, you might want to consider speaking to someone. So, it's no harm here kind of paying an advisor to give you an hour or two of their time to kind of talk through what your options are and where you're going. You need a sounding board in a situation like this. And then, maybe the last one, and it's a bit of a psychological thing, but just realize that, I think it takes people probably 2 years to psychologically recover from a divorce, and probably 5 years to get to the point of a new financial reality where they start to rebuild again. And that's key in this. You need to be patient and give yourself the time.
I mean, what people also need to know is that life changes. How you feel now may well be the worst you ever feel. I mean, it may be the best you ever feel, but that's actually unlikely. And the same is true financially. Things do stabilize. If you have 3 or 4 or 5 years of a regular income and you're able to save just a little bit of it, well, the picture changes. Your trajectory changes quite dramatically, actually.
It does, and I think that dose of kind of the cold dose of reality. If you can go through that process relatively quickly and accept your financial position as it is, then you give yourself the head start to begin rebuilding, and that's the thing about compounding. It does compound against you if you've got debt. But once you start to save and once you start to rebuild, the compounding starts to work in your favor. And the one thing you've got now is the benefit of a lot more experience, a lot more understanding of how life works. And that experience, often helps you to avoid the big mistakes that, younger people would make, or people that haven't been through such a traumatic experience. And so you've got all the school fees, you've paid all the hard lessons, and now you rebuild, but off a lower base and maybe off a lot more realistic view of your life and the world. This too will pass, and you do get out the other side. And a lot of the time, life ends up a little bit better once you've gone through all the stress. And I think people early in the post-divorce don't feel like that. And I understand that it feels like a dark hole, but that changes. And that's the thing here is, give yourself the freedom to breathe, but also be patient. You do get to the other side of this.
We've got 30 seconds left, Warren, but Dave has messaged us saying, evening, is it advisable to sell a bond that you've had, to sell a house you've had a 4-year bond on and start all over buying a new house? I imagine it would depend on the transfer costs and whether the new house is really that much better.
Yeah, so if it's a much cheaper house, if you're going to spend a lot less money, and then maybe those costs of the transaction charges are worth it, but then make peace with the fact that you need to stay in that new place for at least a decade to let all those costs be spread out over a long period of time. But if you are going from a big expensive place to a much cheaper, a much more affordable place, then certainly make that call, but equally, listen to the point. Maybe you sell the big house and then just rent for a while.
Warren Ingram, thank you so much. Really do appreciate it. The co-founder of Galileo Capital, a certified financial planner. This, of course, is available for you as a podcast in a few moments. You might know someone who's going through a divorce. Might well be worth passing this on to them.